Hello, everyone. This is JJ Richa with Pismo Ventures, and I have with me today Jennifer Vancini. Jennifer is an investor, and she's part of a firm that invests in startup companies. And she's going to introduce her firm and also what she does during the conversation today. But before we get started, I just want to talk a little bit about our program today. What we do is we've been running these live broadcasts for the past few months. What we're doing is we're really trying to help the entrepreneurial ecosystem understand what it takes to really build, to grow and sell a company, what it takes to raise capital, what investors are looking for. So we're bringing on board movers and shakers, just like Jennifer, serial entrepreneurs, investors, anyone that would really shed light on what it takes to really start a company and get it to an exit, because that's what everybody's looking for at the end of the day. If you want to get started with your questions, you can at any time. And what you could do is you could just do it in your chat box that you have on your platform there, and then we'll be able to, as we're going through, we'll start answering your questions. Just if you have not subscribed to our YouTube channel, please do so as soon as possible. And also, if you have not followed us on social media, please do so as well. I wanted to also tell you a little bit about, so we have just a little bit about Pismo Ventures. I don't have the slide up. I forgot to put it up, but I will do that later. But so what we do is we are a venture studio, which means we not only invest our capital in our startup companies, but we do invest human capital as well, and we provide the right advice to get our portfolio companies to reach eventually the outcome they'd like to reach. We are industry agnostic, as long as companies are scalable. That's what we're looking for. And Jennifer and I will talk a little bit on what scalable companies are as well. What we do also, we have a software development arm. So for the portfolio companies or for companies that are looking to develop software, we'd be happy to help them with their software development as well. And so what we do is we also trade in some of our services in lieu of equity. We also invest cash directly into our companies. We are building a fund this year, so our fund will be able to invest in our portfolio companies. And also we take you to our network, including Jennifer and others, to help you raise capital, especially if you meet the criteria that the network is looking for. So we truly become investors and partners, and especially if we have skin in the game, we want to make sure that our portfolio companies do succeed. One last thing before I ask Jennifer to introduce herself, we're running a competition, a venture plan competition or a startup business plan competition right now. And so the deadline for that is this Sunday as far as open application. So if you're still interested in submitting your application, deadline is Sunday. I'll put up the link for you to sign up if you'd like to. And basically we're asking for a deck, a 3-page plan, and a 60-second video pitch. And the competition really starts on the 28th, where we go through round 1, and then round 2 starts on the 12th of October. All right, so hopefully everybody can join us. And if you can't join as a competitor, you can always join as a spectator. We have 22 webinars that are part of the educational process that we're hoping that everybody can take home with them. All right, Jennifer, thank you for being here. I'm sorry it took a little longer than I thought for the introduction, but please tell us a little bit about yourself and about your firm.
Yeah, and that's all right. It sounds like you had a lot of important, valuable information to get out there. So busy week or two ahead, huh?
That's right.
So I'm a founding and general partner of Mighty Capital. Mighty Capital is a Silicon Valley-based VC firm that invests in early growth stage companies. So typically Series A, Series B. We invest in companies with teams that are very product-centric, product experts. We believe the best product wins in the long run. And we're able to provide exclusive access to our portfolio companies to a network of product managers and experts, about 300,000 people. So sometimes we source our deals from there, but we often help our portfolio companies sell, hire, get acquired through this large network. So we're a value add investor from that standpoint. We look for strong teams that can build value at scale. I don't think something should be funded by venture capital if it's not a scalable business that's going to go to a certain distance. And we're in companies such as Amplitude, DigitalOcean, Mission Bio. A big percentage of our portfolio would be the B2B SaaS enterprise, mid-enterprise level companies. We like precision medicine in the life sciences sector, especially where it intersects with big data and AI and those sorts of new technologies. So really fascinating things going on where tech meets life sciences. And we'll invest in consumer marketplaces where they have a fantastic team and product and have achieved at least $10 million or so in revenue. So it's a background for Mighty Capital. We co-invest, and we're co-investors. We're not leading deals at this point. But we normally do end up taking a board or board observer seat in the deal so that we can help them tap into our network and help this company grow and get up to that next level that they need to achieve.
That's good. A little bit about your background.
Yeah, my background, where to start now? I started out very entrepreneurial. I was the 5-year-old on the block trying to get kids to pay me to come play in my backyard. So kind of entrepreneur by nature. Always enjoyed working for startups or that innovation digital group within large companies. So before I became a full-time investor, my background and my career had led me to the point where I was doing business and corporate development, strategic deals, really the blank sheet of paper kind of deals between companies that were building their ecosystems and leveraging each other's strengths to grow their market and their revenue. I've worked in the security industries, worked for a crypto company before encryption was a household name, before the standards were getting built and so forth. Segued that into a lot of wireless and mobile expertise. Worked for Symbian, if anybody remembers Symbian, which was really a consortium company. It was a private company, but owned by Nokia, Siemens, Samsung, Motorola at one point. Their goal was to make sure Microsoft, the big US Microsoft company, didn't own the mobile OS market. So a lot has changed since then. They were the leaders in driving smartphones in the early days. Went back to security for a bit. So I've got a lot of kind of horizontal technologies expertise in security, operating systems, enterprise, and so forth. Yeah. So one of those paths that when you work backwards, you can see how the line evolved. But coming out of college, I thought I'd be a trader on Wall Street. And here I am in a much more interesting. I think this is much more interesting and rewarding than being a
trader, that's for sure.
Yes, than doing that, yes.
Because you're always in touch with new innovation, with new ideas.
Exactly.
It's so much
the variety.
Oh yeah,
the variety, and you can see what's coming, like what's going to be a Fortune 1000 public company, right? What kind of technologies, what kind of people? Yeah.
Very, very amazing. That's very true. That's what I like about this too. I'm always learning new stuff. So
exactly, every day.
All right. So you touched a little bit about Mighty Capital and what you do, but tell us a little bit about your investment thesis. How do you do it?
Yeah, our investment thesis is to invest in those early growth companies where they have shown product market fit. So they've solved a big, hard problem, or seem to have, and are starting to get product market fit and validation in the form of traction. Traction to us means revenue. There are some cases in life sciences where it may mean the right kind of partnerships and whatnot. Yeah, but FDA clearance, Medicare reimbursement codes, or whatnot. But getting traction, being able to prove out their revenue model, and that it monetizes. So our investment thesis is to find those companies with teams that are solving that big, hard problem where there's a big enough market for us to see the opportunity. We invest in US-based companies. Initially, we invested on the coasts where we had also a strong, I mentioned Products That Count. That's our network, our sister network, if you will, of product managers and product experts. They have chapters throughout the US and now one in Toronto as well. But our strategy was to invest where that was strong. We get deal flow from there. We started expanding, looking at the investment horizon across the US before COVID. I mean, now it makes total sense. You can't go do site visits anyways, right? Everybody's working virtual. So we're currently US focused. May look outside of the country when the world starts to open up again, but right now there's definitely enough business to do here. And many of our portfolio companies came from other countries and ended up domiciling their organization in Delaware, of course. Yeah.
Yep, that's what they're doing. Yeah, to tell you the truth, we do the same thing. We don't look internationally at all. It's just not worth it. I'd like to actually touch them. If they're within a 3-4 hour drive is better, because we can add a lot of value because you meet with them and you especially if you have a board seat as well. So, but now we're in the Zoom world too. So
yep. Yeah, and it will change. It will change how we get used to interacting. There's still a lot of reason to be in a financial center like San Francisco, New York,
right.
And some others are, of course, propping up because it just accelerates your business. If you have some management or some expertise in these locations, it's about where can you grow your ecosystem, find your marriage partner someday, right?
Yeah, exactly. Yeah. So talking about your investment thesis and product market fit, I think really at any stage you have to have some product market fit and some traction. And traction meaning it could be paid customers or even not paid customers, but someone that says, "Oh my God, I can't live without this thing," right? So,
yes.
So what if someone is pitching to you, what do you look for in that initial pitch to say, you know what, we got to meet with these guys?
That's a great question, because your pitch is really everything in that first meeting, and it doesn't have to be. You don't have to boil the ocean. That's a common mistake. Don't tell me everything about your product and show me all the features. We'll get to that if I see that you're ticking some boxes. We're looking for that unique team, like why your team to solve this particular big and hard problem. How is that solution that you've come up with differentiated? Is it sustainably differentiated? Either because of your team or patents or partnerships or sales traction or your investors, whatever gives you a moat. As a result of those things, are you gaining solid traction, which you're able to monetize fairly? Do your financials look promising? What's happened in the past? What's happening today? Are you growing at the rate one would expect for your kind of business? Are you watching the burn rate? I mean, we've always thought that's important, but what's your burn rate? How long is your cash going to last with this raise? To get where you want to go, do you understand like the reasonable amount of funding you need to get there? Do you have a credible plan then to really generate significant returns for the investors? Because investors at the end of the day, especially given the risk in earlier stage companies, are looking for outsized performance. So if we see the makings of that kind of story and the pitch can tell that story in 12, 15 slides, you'll get to the next meeting. And we screen a lot of companies. At the top of the funnel, you might see 4,000 opportunities a year. We'll bring in about 400 for in-person. Let's see if they answer these questions, right? See if they fit. And are they fitting our investment thesis in terms of where they're located and so forth, and the sectors that they play in. Then we'll continue to other meetings and get to due diligence and then invest in that small number. But those are the key things that we look for when somebody comes in to talk to us. There are other things we might evaluate, but if you do well on those key things, you'll get the next meeting.
Okay. So I want to ask you a little bit about the moat. So when it comes to moat, how important is someone having patents, especially at that early stage? Because the reason I'm asking, because I know a lot of companies, they end up spending a lot of money on patents,
Yeah.
and they can't defend those patents because if someone infringes, then so is
They
it
don't have the
that
money to
important?
defend them, right? Yeah. It's
Exactly.
expensive. Yeah.
Very
It's
expensive.
really, it's expensive. I think patents, some people it's absolutely critical. There's definitely different points of view here. I worked for a company that had a very heavy patent portfolio, but to defend it was just impossible. Having patents or filing some kind of patents, it does show you may have a moat. It does show technical expertise and credibility, right?
Yeah.
It shows down the road it can become really important when we start looking at M&A. I think that's where you might get more value.
Yes.
It's a
Yes.
common, when a large company is doing build versus buy and they run into patent issues, or sometimes they might acquire you because they can afford to defend those patents.
Yeah.
Even if it's not their core business, it helps them build
That's
their
very
bigger
true.
moat. But it is one way. Yeah, in certain industries like hardware designs, it's more important to see. It's really hard to patent a lot of stuff going on in cloud SaaS solutions, right? But we should
Yeah.
still have some
Software.
secret sauce. Yeah, yeah,
Yeah. So yeah, we had Quan Wen last week. He's a patent attorney, and he was talking about software is hard. It's potentially the algorithm, but at the end of
yep,
the day, can you defend those patents? so,
right.
so I have a question from Curb Crabtree, and he says, of course, conditions you listed. Which ones do you see startups stumbling the most or hardest when it comes to them pitching to you? Are they, which pieces?
Yeah, it really varies. I think, proving that it matters, that the product matters, right? That it really is sticky and that it's a big enough market. There's that issue. The financials, not having a realistic projection, a credible projection, not knowing your numbers sometimes, and knowing what it costs you to get a customer, the long-term customer value, the average cost, the average price you can get from a company. So around financials, a lot of people are not as slick and on the money as they should be in terms of looking at that. I think a lot of people too have trouble with looking long-term at the funding, and I recommend entrepreneurs really start at the end and work backwards. Of course, you don't know exactly what your end game is, whether it's M&A, IPO,
Right.
lifestyle business, right? Go on forever. You don't really know, but you sort of have a ball of clay there you're working with, and you have an idea of where you're going, and try to work backwards so that you always have options in place for how to get there. And a lot of people don't tell that story, that end-to-end story of how you're going to make me as an investor significant returns, and have a reasonable, credible story to get there.
Yeah.
I
Yeah.
hope that's a specific enough answer.
Right. It's not easy to answer that question.
It isn't,
uh,
because everyone has something. Very, very, very few companies, by the way, get 100% on all of these things.
yeah.
Yeah, but the indicators are usually there. So
Kirk is also asking for your company contact information. Would you be okay if I forward to him your
that's
contact info?
yeah, that's fine. Yeah, we have a deal flow process, and
All right, very good. So Kirk is also an investor, and he's trying to build a fund.
okay,
I remember my conversation with him a couple of weeks ago. So
okay.
I'll send him your info.
You're
All right,
brave.
so
You're a brave person. Yeah.
yeah,
It's entrepreneurial in and of itself to build to build a fund and a venture firm, right? And
yeah,
we look
exactly.
at, we look at what we do in each fund as a product, and we product manage it and think about the product roadmap. It's the way you have to look at it.
Yeah, yeah. Okay, so you said you're talking about traction or revenue. So is it is there a number you're looking for, a monthly recurring revenue, or what are you looking for when it comes to traction, specifically when it
Right.
comes to revenue, I guess?
Yeah, and it does depend on the company. Like I said, if it's B2C, consumer marketplace stuff, you better be in the $10 million range, right? Of revenue with growth rates of, triple level growth rates every year. B2B SaaS company, if we're investing Series A, I think the industry standard is you're at $1 million in ARR, although I think that number is moving up because we're seeing a lot of seed stuff now at that revenue level. But a lot of it is how quickly are you increasing your revenue and how is it impacting your gross margins? So starting to see that pick up, but definitely quarterly by quarterly growth rates that indicate you're getting traction. So 1 quarter of data, 2 quarters of data, not quite enough to say you're a Series A company. You need a good solid year. Yeah.
Because if you're looking, I mean, if you're going for a Series A, you better have some revenue. I mean, you better have real traction.
Right.
Otherwise, you're probably not there. Because nowadays, and I don't know if you're running into the same thing. I mean, someone came to me last week. He goes, "We're raising at $10 million. We're pre-revenue, and it's Series pre-seed." I was like, I don't know what that is. It's like so
Series pre-seed. That's friends in the family, right? Friends and family. Maybe you can find more friends. Yeah.
Yeah, and more friends.
Yeah.
Yeah, it's sometimes it's really the nomenclature and what people are doing. I don't get it. I mean, sometimes I'm hearing I need $5 million seed. I was like, okay, or $20 million seed, and they don't have revenue, and I don't understand it. So it is a lot of things are different than what I've been used to, at least. So yeah. So how okay, so are you agnostic in general as long as the companies are scalable?
In terms of the technologies we invest in?
Technology or the sector?
Not 100% agnostic. No, that there's definitely some boundaries. So we like I mentioned, B2B SaaS.
Right.
We like certain consumer marketplaces. Within life sciences, we like precision medicine stories, some device stuff. We would not do pharmaceuticals, though, necessarily, right? Anything super capital intensive is typically not where we would play.
Okay.
So clean tech, space tech, those sorts of things. And we want to, within our own expertise, within our team, we want to make sure we're able to bring our own experience and context to bear, right? So if it's even in B2B SaaS in some area where we don't understand it a lot, we would be inclined to say they need an investor that can help them out more than we can.
Right. So do you like companies that if you're doing Series A or Series B, do you like companies that are going to go to Series C and Series D, or would you like to be that last investor?
No, we save money for follow-ons, for reserves. We want to see them keep growing and exit at the right point to exit. Sometimes a great point to exit is while you're raising Series B. If you're starting to get acquisition interest, take a look at it. It depends on a company's personal motivations and, not selling too soon. If you still are onto a great thing and you're growing quickly, but it also depends who the acquirer is. But we'd like to see companies grow. We're not necessarily investing for the unicorns and the IPOs. Having said that, somehow we ended up with not somehow, I mean, we make good decisions, but we have 5 IPO candidates in our first fund that have just performed extremely well, and they're on that track. But we're happy to see, we like I said, reserve money for follow-on. We're in it for the long term, and we just hope to see them exit at the right point for the business to bring back the returns to our investors, right?
Yeah. So talking about an exit, what if someone is basically too early to predict what an exit may look like? How would you deal with something like that?
Well, want to get a sense for what their motivation is then. Like, no, they may not know exactly, but they should know their sector, their field of expertise well enough to know who are the typical acquirers and why do they buy and at what metrics do they buy. You can research that. You can find that. You should have an idea of that. Some, for personal reasons, really want to ring the bell in a public market, and they think it's big enough, a big enough market, a brand new category. That's fine, you know, but you should have some idea of how a company similar to yours, you know, many have been similar to yours, what path have they gone through to the end game, and see what's typical, right? You know, another possible end game is you generate lots of revenue and a PE firm buys you for that, private equity. But you should have some sort of idea of, once you create enough value, how are you generating that liquidity back to all of your investors, not just the venture capitalists, but your brother and sister-in-law who put money into the company, and anybody else on that cap table, right?
Yes, it's really important. You can go start another one. Just sell it.
Right. Go start another one. I have a friend, I know somebody in venture who's like, for that first time CEO, when we see that there's a promising acquisition and he or she is just mentally not ready to give up the baby and think, oh, am I leaving money on the table for 3 years from now? You just sort of say to them, well, you need to start thinking about how you're going to spend that money. Would you like some introductions to investment advisors? And are you starting to look at real estate in Sonoma County, you know, whatever?
Yeah. So, you know, it's happened a few times during my career and you know, as an investor. And so there was an opportunity for a company maybe about 5-6 years ago. They were in consumer products, and they got an offer to be sold for $40 million, but the entrepreneur, you know, wanted to stay and continue until they get sold for $100 million. And so the entrepreneur would have made about $12 million themselves, and maybe, I don't know what would the multiple be for the investors, but they ended up maybe about 6 months after that offer, they ended up being, you know, the company kind of almost filed bankruptcy, and they were $500,000 in debt themselves, versus selling for $40 million and have about $12 million in their pocket. And we would have helped them, you know, invest it or spend it.
Right.
So, well, you're
Every
right.
dollar is worth what it is today, right? And yeah, that's sad. I think there is some research that shows the best IRR, internal rate of return, is if you sell at like the 3-year mark, which is unusual. It's early.
Very, very unusual.
But if you sell it at that, that's going to be your best internal rate of return. Remember, you want to sell at 100 million, you're going to have to keep raising more and more money to grow your company to get to that level. So,
very true.
The least risky thing is actually to sell, unless you really are in a new category and you don't think it's a good marriage. But yeah.
Yeah, I mean, sell, pocket 12 million, start something else, and
exactly.
you have plenty of time, and you have a lot of time, and you can actually spend time on actually researching and building the next company, really.
Right. Yeah.
So, how important is diversity for you guys?
By diversity, I assume you're raising the gender race question.
Gender,
so topical.
Right?
Along with COVID, diversity, like these are the two big subjects this year. Well, you know, it's interesting. 2 out of 3 of our GPs are women. Our LP base is fairly diverse. We have a diverse team. It hasn't been intentional. I can't say it's coincidental either, because our networks are our networks because of who we are, in a way, right? So we do think it's really important. But I've seen a noticeable change in the last 5-6 years, from, you know, talk about it to action, to very intentional action. Like, it keeps getting ratcheted up, where For example, LPs, big LPs are starting to push down, wanting to see transparency in the portfolio companies. We're not getting a lot of that, but I'm hearing that we don't need to. We actually have fairly diverse sets of founders in our portfolio companies. I'd say most of the companies that pitch to us tick a box at least once in terms of senior management or board members for gender and race. It's very unusual now to see a company that's homogenous. And if they are, it's usually white guys who had worked together in their previous company and went off and started another company. So they're still small and they haven't grown yet to be able to bring more people into the company. I think it's important for a number of reasons. One being, if we believe the best products win. And any organization, especially as it gets larger, is a microcosm of greater society. So to be able to build the right product and build it right for the markets that you're serving, it's better to have representation of multiple experiences, thoughts, complementary skills, and so forth. So there is increasing research that diversity yields better outcomes and results. We haven't had to be super intentional, though, about getting that next investment, making it a diversity investment, because, like I said, I find our portfolio companies are already pretty diverse. Maybe I should look at their boards and see if they are, but anecdotally thinking about it, they are. I mean, when we sit on it, 2 of the 3 of us are women, so there you go, right? But it's increasing in terms of its importance to the broader stakeholders at large, and it is harder. Some of it is a time lapse for this flywheel effect. It's harder for people who don't have the funding networks, who are not repeat CEOs and founding teams, to go get that money. And the large successful VCs, they're funding successful CEOs they've already backed or their friends, right? And so they don't necessarily have to intentionally go out and get a lot of other deal flow, but and so you need that flywheel effect of successful teams going out and creating the next set of startups.
Yeah.
What's your view on that, if you don't mind my asking?
No,
what are you seeing?
I think you're probably right. A lot of the companies that we're seeing or we see, investments in, they are diverse, and I don't think we're investing intentionally in diverse companies, regardless if it's Pismo Ventures or I belong also to Tecos Angels, which is a very large angel group. So we're investing in companies that are really across the board. So we're seeing diversity from different sides, not only male and female, but different ethnicity, etc. That really were. And again, it's unintentional, but we do see it because we're welcoming it. Because a lot of times you see people are saying we need to invest more in female founded companies, but I think last week Tecos Angels invested in a female led company, and in the past 3 months we probably did 2 or 3 of those, if I remember correctly. But we are.
They've been on the increase. Yeah. Definitely see a lot more. Yeah, a lot more female CEOs. It's something I've been sensitive to since I was, 5, and started to learn it's not a level playing field, right? I mean, I was one of 2 engineering students in my undergrad class, entry class.
Yeah.
And when people say to me, how is it being a woman in venture? I'm like, well, I was a woman in cybersecurity. It's way worse. That's much more challenging, and it still is today. So any guys out there in that industry, that's one that needs to crack open a little bit. But I'm encouraged by what I'm seeing. Yeah, it's just changing. I really strong will, and that's good.
Yeah, just to remind the viewers, please go ahead and post your questions. We'll be happy to answer them. What as a VC, I know you touched on that a little bit, but maybe we can go a little bit deeper. What do you evaluate during your due diligence? So first, maybe do you do background checks? Do you look at previous due diligence that was done maybe during a seed or pre-seed round? What do you evaluate?
We're very involved in due diligence. We have a heavy due diligence process. We try to make it as painless and quick as possible, but it's really important. It's important for the entrepreneurs to go through that process with us to see how the relationship will work. But we ask for a data room with certain materials, financials, corporate documents, cap tables, whole list of stuff. I think it's even on our website what we ask for. So the more somebody is ready with that before they fundraise, the better. We'll look at, we have a checklist of things that we look at. We form a due diligence team, who's interested in really looking at this to do the work. So we'll look at the team itself, the background checks, the founders, the co-founders, the board, the advisors. We'll look at the product and the market opportunity, the business itself. How are the revenues, the cost structures, the competition, the defensibility. We'll look at the deal. Does the deal make sense financially? Financially analyze the deal, look at prior funding rounds, look at potential future rounds, look at their current investors. We always do calls with the lead investors, the past major current investors, to make sure we're aligned. And then we'll look at the fit with Mighty Capital. How can we bring value to this company? Does it make sense for us? Can we leverage products account for them? Can we leverage our personal networks for them to help them grow their business to the next stage? So we do a lot of deep dives on these areas. And we do customer reference calls and so forth. And we like to have, in the old days, we would do a site visit. Okay. get a sense of the culture. Yeah. Culture and team. We like to talk to the senior management, not just the founders at some point, and see how they engage, assess if they have complementary skills. And then later in the process, we'll do there's a whole legal due diligence. Is everything, tied up the way it should be? What are the terms of the deal, the nitty gritty? Can we get a board observer seat so we can bring that added value? So it's a long process, but somebody who hasn't been through it with us or anybody else is often surprised how deep it goes. But it's a serious investment, and we're spending other people's money as well to make this investment. So we have to be careful.
So how long, talking about that, how long does it take from somebody that pitches to you the first time all the way until they get an investment, if they do?
A lot of times that depends on the company and how organized and ready they are for due diligence. Also how late they are in their fundraising. So you asked, do we look at other people's diligence? Yeah, if they'll share it. And if they're already at that stage. So if they have a strong lead and, are rounding out the round, it's usually much quicker because they've already had to get all this stuff together for the diligence. But if it takes a while to get the data, to have the customer call, it can go on for a while. So the shortest time, it might be 3 weeks. The longest time, it can be months. The longer it goes, there's deal risk there then for the company because you get deal fatigue and something else comes along that looks better.
That's true.
Yeah.
There's that dynamic as well, right? So yeah, it goes for months. They're not ready, and they could lose that opportunity.
Right.
Very true. I don't think we've ever done anything as short as 3 weeks, maybe a month, but so
it would be hard.
It's very hard.
Yeah.
So what is on the flip side, I guess, what is a good profile, or what is the profile of a good investor?
Profile of a good investor. That answer might be slightly different for each company trying to raise money, but we think it's somebody that, first of all, has some expertise or contacts in your area that can be helpful. So we believe in value-add investors. Don't just take the money, make it smart money. And really good CEOs will come back to us right after the investment with, okay, I need introductions for these candidates I'm hiring into these companies I want to sell to. I'm looking to build out my board of advisors. I need a new IP lawyer. I need a new accountant. They'll come back to us and like really eat from the trough, so to speak. But you should really look for that, and somebody that will help you work through. Growth is never linear and straightforward, but help you work through those step functions of growth and the next raise. Ideally, they have money for follow-on investments, perhaps networks to help you get other investors on this deal and the future deal, and alignment, I think, on the end game for the company and where it should really go.
So talking about that, I one of the things that I really try to do with portfolio companies, regardless, I mean, if it's through Pismo or through TCA, is looking for communication, ongoing, continuous communication. Is that something that you encourage and you look for? And how about reporting? Maybe do you look for regular monthly? Is it quarterly? Is it yearly? What do you look for?
Yeah, so we require quarterly reporting. We always get major investor rights for information and so forth. I think it's to a company's benefit to be open and transparent about what's going on. When we're on the board, clearly we have lots of communication and get a lot of information. But I think even for all of your investors, to do a monthly or even quarterly, monthly during COVID maybe, but during crisis, but quarterly update on state of the business, your real challenges when you have a shock like a COVID or financial meltdown, or we've seen things over the years, right? Show that you're resilient, you have a plan, over communicate with your investors. And if you make it a regular cadence, you're less likely to get the one-off emails and phone calls. If you share that information, also ask them to help you market. Make sure they're following you on Twitter and LinkedIn if you love to post your stuff, so that they'll repost it. Like, use them to build your brand, build your ecosystems. So we also have for each company somebody that has to engage with them frequently. To know what's going on with the company so that we can step in and help where we need to. So we very much operationalize how we work with our portfolio companies. I think to your question, the more an entrepreneur takes reins themselves and is open and communicative, the better the relationship's going to go with investors, and the easier they're going to find it to raise capital the next time around.
Oh yeah, at least also they show they're coachable, they're willing to work with their investors, they're professional, and do you do you have a specific format that you look for reports or communication? Or because I've heard of a bunch of companies just in the past few weeks saying, what we do is we do the reporting on behalf of your portfolio companies. We use a set of parameters, and then we give you consistent reports on a quarterly basis. Or do you just you say, I just need this set of data and just send it to me?
We tell them how we like to see it. And we're using tools like Airtable and Carta to help organize that. We haven't.
What's the other one? I know Airtable. What's the other one?
Carta. Carta.
Yeah.
So a lot of it's an interesting company. They've really gone after the privately funded companies to keep track of your investments. And I know our CFO works with them a bit for the reporting elements. And then we have, as a team, a portfolio review every quarter. And so we want that data to be in the same format for each company. We are getting outreach from companies that will put this together for us. I'm curious to see what will happen. Money is shifting more heavily into venture and private equity. It's gone supposedly from 3% of a big institutional investor, average 3% of their portfolio, to 12%. So I think we may see over the coming years more standardization around reporting because of that factor, but we'll see. Yeah.
That's very interesting. All right. So let's talk a little bit about what really would influence. Again, we touched on some of that, but what would influence an investor's decision other than a specific deal pitch? What would make you say, I gotta invest in this one?
The quality of their investors.
Okay.
Makes a difference. Like if they have a tier 1 to even tier 2 Sandhill Road kind of company behind them, it's a lot less risky than a small strategic fund from a corporate venture group, for example, or so the quality of the investor syndicate, the customer references, very strong references that say, I would invest in this if I could. I would, I told them I want to buy them. If they ever look at getting acquired, I hope they come to me first.
That's a big one,
really
right?
Strong. Yeah, and I've heard that. Just really strong market validation, promising revenues, kind of a new category, very strong repeat founders as well. It's harder to say no to people with a successful track record.
Yeah.
Yeah.
So you said you're not looking for a unicorn, but would you be looking for a disruptive technology?
Oh yeah, of course. Yeah. And if they grow to be a unicorn, great. Just doesn't have to be. And now these unicorns, I mean, it's practically up to Pegasus level, right? So some of these deal sizes and the exits, we're way past unicorns. What's $1 billion anymore, right?
You're right. You're absolutely right. It's so one of
disruptors, category changers. Those are fantastic opportunities. Yeah,
something that's been done for decades in one way, and then you find that it could be done differently, more efficiently, or add a new category to something, which adds a little bit of a challenge in that educating someone on a new category, but still. So
it does require more money. It does. Yeah. Requires a lot more resource. Yeah.
A lot more resources. Yeah. As we have one of the webinars. We have 22 webinars in the competition. One of the webinars is titled, "You're Not Yet a Unicorn."
Because you hear so many say that they are or they will be. Yeah.
Right, exactly. You're not yet a unicorn. You could be, but the issue is I think you go through the same thing. Everybody that comes to us, we're a unicorn. We have nobody else is doing what we're doing, and we're going to be whatever and whatever. But it's not really the case. 99% of the time, it's probably not right. So.
Yeah, and I've heard founders say to me, sometimes they say that in the pitch room because they think it's the right answer that we want to hear.
Yeah.
And of course, we want to hear you plan to go big. But sometimes people leap over all kinds of stuff to get to, I'm going to IPO. It's the worst I heard was $500 billion for an HR platform. Like, no, there's like no credibility in that number, right? So.
Yeah,
we're going to exit for $500 billion. Okay.
Yep, that's very true. Kirk is asking another question. He says, I think you stated that you rarely become lead on a JV. So what are some green flags and red flags you look for from a lead?
Right. So if it's a Series A or a Series B kind of company, we like to see leads that are financial VCs versus strategic VCs, simply because they look at the deal more from a financial return perspective. And with some exceptions, their due diligence is much more rigorous than a strategic VC. Doesn't mean that it's not the right funding path for a company to have a strategic lead, but it's not necessarily the right investor for us. So red flags would be they're not doing the right diligence. They don't have a good exit track record. Do they have, an important thing is that they have enough money basically to carry the firm into the next round or to bridge the company to really be with that company long term. So that's why we like to see, that's one of the reasons we don't lead is we write smaller checks at later stages. As our fund grows and so forth, we will take on leads, and we're often asked to, but we really think it should be somebody that can do the heavy lifting in each each stage of growth, and can be with it for the long term. So that's primarily why. Not having a real lead is a red flag. You asked about red flags. Party rounds. So, for example, 5 people piling onto a convertible note where the terms were set by the company, that's a red flag. We want to see terms set by outsiders that have fairly evaluated the company and the risk.
Very
I think that
interesting.
answers the question, JJ. Or what's your view on that?
No,
Yeah.
you're right. I agree. A lot of times, at the angel level,
Yeah.
we do, we get the terms coming from the outside, but I'm gonna say 90% of the time we change it. We actually change the terms. Right. It's never the same, especially because they have unrealistic, either a cap, unrealistic terms.
Right.
Valuation, same thing. So it does change quite a bit. But we're seeing, we saw a little bit earlier, maybe valuations go down, but I'm seeing some valuations go up lately, which is really all over the place.
Yeah.
I'm not sure I understand what's going on to some extent.
Right.
Yeah. But it needs to be, Oh, let me ask you this one, because we do this all the time, both at Pismo and at Tecos Angels. Do you do reverse vesting? Or if you're not familiar with that, it's basically you're taking away equity from the founder and say, we'll give it back to you over the next couple of years, just so they leave, in case they leave the company.
Yeah. I guess we look closely at that bigger issue of founder skin in the game, founder alignment of incentives,
right.
Founder commitment to the long term. We do spend a lot of time looking at that.
Right.
I personally like to see that the founder has had to write a check. For a number of reasons. First, it just means they really believe in what they're doing. It also means their family believes in what they're doing and is behind them. It's an indicator, because that's a risk point if there's tension at home. But we haven't looked at reverse vesting. We would want to see. I'm pausing now because there is one case I can think of where one of the founders was fully vested, but he had an accelerated vesting schedule. So we normalized that when we did the deal and went back to the 4-year kind of thing. But at a Series A, a really healthy team would still have 40% of the company at least. Don't always see that. But we want them to have like a big stake in the game. So
otherwise, there's no incentive for them to continue.
There isn't. Yeah, there isn't.
When you see someone, there's a company we saw the other day, and they're still the CEO founder has like 5% left. And that's not enough.
That's not enough. And depending on what stage they're at, the board should be getting them stock options like an employee as well, so that they continue to have that incentive. Yeah.
Yeah, that's very true. I got a question from Michael DePaul. He says, thanks for the chat. How important is secondary market research example size in the pitch, or is it more about traction with potential customers?
Yeah, good question. Some market research that shows and educates us on how big is the market for what you're doing. And I know these numbers are super high level and they're always debatable. But proof to us it's a big market, it's a growing market, in that you're not playing in too narrow a space. So it is important to talk about how large the market is and how fast it's growing, to have that total addressable market and what you're realistically going to address. One thing I personally don't like is if somebody says, oh, this is a $10 billion market, so if we only get 1% of it, it's this big of an opportunity. I'm like, if you get 1%, you're not leading in that market. Like, that's exactly. Not, there's a problem there, right? You got to be one of the top. How are you going to be one of the top players in that market, right? And traction with potential customers is just proof that you can really develop your opportunity within this large market.
Yeah. So I'm going to ask you a question around that too. So, a lot of people come, startup entrepreneurs, and they're saying they're trying to make the market bigger than it is. And it's 10 billion or 5 billion. And in my opinion, you don't need that much. A billion is way too big already. Maybe 500 million is huge. So do you look at that as, and does it have to be 10 billion?
No, I mean, it has to pass a sniff test too, right? Like,
yeah.
It's sort of like, does that pass the sniff test? It's like, okay, within this $1 billion market, like, what sub-market of that are you going after?
Right.
And are you going to win at, right? And is it big enough to grow? Or will it flatline? So yeah, I agree. There's no one particular magic number because it really depends a lot on the particular company, solution, what they're raising, and how acquisitive that space is in terms of M&A.
Yeah.
Right.
Yeah, that's true.
But a small market would be, a small market. Let's do small market example, right?
Yeah.
Food delivery service in Cincinnati, Ohio, Indian food. Okay, that's my market. And then I'll move from Cincinnati to Cleveland and then Dublin, Ohio. And it's like, okay, that's not really a big market.
Right.
That's not venture fundable.
Right, yeah. Exactly. No, that's true. All right, so question from Gary. He says, what amount of friends and family funding are you looking for, a percent of the raise, number of friends and family investors?
Just no magic number there, to be honest. We would want to see the first money in as friends and family or yourself, right? To really get it off the ground, and we'd like to see it stay in there. We don't, occasionally you'll see somebody say, well, with the next raise, we're going to pay some of that back. No. So it's no percentage. There can be too much, to be honest. Like a cap table with 100 people on it, even with the same terms, is a bit messy. It's not a deal killer, but it's messy. I really like cleaner cap tables. I think to answer your question, enough to get going before you can raise that first early seed raise is what, whatever you need to get it off the ground, right?
Yeah, exactly. All right. So, I guess, we're about 3 minutes away from the end of the hour. Time goes by real fast. So what I want to do is I want to ask you I'm going to do some closing, ask you to come up maybe with one advice, one recommendation for the listeners to say, do this. So I'll be right back. Think about it. I didn't want to throw you a real curveball, but maybe give you a little time to think about that. So I'm going to do some closing and I'll be right back.
Okay.
So thanks everyone for being here today. And thank you, Jennifer, for being here as well. So just to give you a heads up on next week. So first, again, if you haven't followed us or subscribed to our YouTube channel or followed us on social media, please do so. Also, this YouTube broadcast will be available for is recorded and will be available by tomorrow morning to share with your friends. And Jennifer, you could share with anybody as well. So it would be on Pismo Ventures. YouTube/Pismo Ventures. That's where it would be. Just to give you a heads up, next week the topic is life sciences. So investing in life sciences. We have two prominent investors that I've known myself for a while, Jay Cormier and Dr. Thomas Lee. They both will be on next week to talk about life sciences. They're going to talk about the trend of investing in life sciences in Southern California, Northern California, and nationwide. So they'll discuss that. We're going to go dark in October, just because the business plan competition that we have has 22 webinars. There's a lot of stuff going on. So we'll go dark in October, but we will be back in November. So, but next week, still September. So, and it is about life sciences. So hope to see you next week as well, and hope to see you all as either competitors or spectators on at the competition. I just put up the URL for the website where you can go and sign up if you'd like to. Jennifer, what is that one thing?
The one thing. Yeah. I mean, we're talking a lot about pitch decks. Let me say, make sure your pitch deck tells your story in a way that ticks those boxes we talked about earlier. And part of that story should be you. People invest in people, right? So why did you start this company? What led you to think that this was a problem you could dive in and solve? Why does it matter to you? That makes a difference. So that's my one piece of advice. Yeah.
There you go. Well, Jennifer, thank you so much for being here today. That was really great.
Yeah, thanks, JJ. It's always fun to chat. So thank you.
I
hope it was useful to the listeners, and good luck with your competition and all the companies that are going to go for it. So.
Yep. Thank you. So I know you're not going to be one of the judges, but one of your partners is. So we look forward to working with you guys as well. Thank you so much.
Okay. Good luck.
All the best. Bye-bye.